how much confidence do you have telling investors to buy this market with those big looming uncertainties like where this virus heads next?
Right. Well, we're looking for pretty limited upside to the market this year. Our S&P 500 targets 3,300 for the year end. So we'd actually gone above that earlier in January. And, really, we think the market got a bit ahead of itself, maybe pulled forward some of those gains for the last few months. So, I think this year it's really going to be about earnings growth. We saw last year the market was entirely driven by multiple expansion. This year, we think we're expecting 8% earnings growth on the S&P, so we think that's really going to be the driver and what investors need to see come through as we look to this earnings season. But certainly factors like the virus, geopolitics, other sources of uncertainty, could have been a reason for some of the volatility that we've seen most recently, the virus.
So if it's all going to be about earnings, Jill, which sectors do you like as far as which ones could beat and see improvement over the last few quarters?
So far, a couple of the trends that we're noticing from earnings for what we've seen reported in the first 2 weeks are that, we're seeing strong results from tech and financials. Reported companies overall have seen their results come in about 4% better than expected. And, the upside surprise has been that margins have been a lot more resilient than consensus has been expecting. So, that's one positive sign. Financials is our preferred value sector right now. So even though we've seen a bit of a reversal to growth stocks outperforming again, we do expect to see a value rotation in 2020. One of the biggest drivers for rotations into value is a pickup in profits growth, which, beyond this fourth quarter earnings season, we expect profits growth to continue to pick up throughout 2020. So as we start to hear more and more on 2020 outlooks and confirmation that pickup in profits growth is real, that should drive a rotation into value stocks where financials has shown surprising earnings resiliency. It's a much better, higher quality sector, less levered than it was, going into the last crisis. Now it's the highest shareholder return yield sector in the S&P. So kind of the new high quality income oriented sector.
Yep, they're the worst things than having financials lead, Jill, that's for sure. Some argue that even though the percentage of S&Pers that are beating estimates, which is in line with the 1-year, 5-year average, that the upside surprises are smaller than average on a historical basis, and that does suggest some margin pressure in play. Do you not agree?
So far, the breadth of beats has been pretty healthy. We're not looking for a huge EPS beat this quarter. We're looking for about 1% year-over-year EPS growth. Consensus is looking for about down 1%. So, we've seen a lot of the margin expansion this cycle. The margins, as I mentioned, have been coming in more resilient than expected, which is a positive sign. But, I think we're going to be watching the commentary from companies. A lot of the macro gauges of margins that we track have started to tick up a bit. And more broadly, we're seeing a lot of the more cyclical indicators and other proprietary indicators that we track across BofA have been suggesting a cyclical pickup. So, overall, when you look at commentary on earnings calls so far, the positive is that companies have started to express more optimism and even doing, word counts of mentions of things being better or stronger versus worse or weaker on the earnings call so far. We're seeing those right now tracking their highest since tax reform was passed in late 2017. So that's the positive, is you're definitely seeing a more optimistic tone. Now we'll see if that carries through as some of these, bigger multinationals report now that we've seen the U.S.-China trade deal, as to whether that optimism will carry through to improved CapEx spending, because that was really been, a weak part the past several quarters.
Optimism in the consumer confidence numbers that just came out at the top of the hour. Rick just reported them. And durable goods, I guess, on the headline was good because of defense spending, but the core not so hot. Certainly Boeing is a weight there. So uneven manufacturing recovery, Jill, but the rest of the economy looks good. What's it all mean for the Fed, which kicks off a 2-day meeting today?
Right, and we're overweight the consumer discretionary sector in part due to the strong consumer. Also because consumer discretionary stocks tend to perform better. When the Fed has an easier bias relative to typically late cycle when the Fed is tightening, consumer discretionary stocks tend to underperform. So we as a firm are expecting the Fed to remain on hold this year. So no big changes there in terms of the interest rate backdrop. Recently with the drop in the 10-year yield, you have seen some of the yield-oriented sectors start to see better flows. But really, we're expecting no further Fed rate cuts this year. The economy has been supportive, starting to pick up a bit, and the 10-year yield should end the year at around 1.8% is what we're expecting.